Mining production down once again, from the gold front. Let's start off with that point, because clearly we have been seeing a bit of pressure coming through and the gold price rallying quite significantly. Just looking at these numbers, Nikki, do you think they're significant?
Well, I think that it just, adds to a long-term story that we're well aware of. I mean, we still have significant gold deposits, but they're hard to come by. You have to go quite deep. The cost is quite prohibitive. You have fairly aggressive unionization in the mines, which also drives up the cost. And at the same time, of course, we've had some problems with electricity that has made expansion. Exactly. That makes expansion difficult, and all of those things have over time led to a situation where you just have a declining yield, and consequently you have less production. And I think that is what is mirrored in here.
Laura, your view on that data, because 12.1% rise in overall mining production doesn't look too bad. Yes, gold disappointing, particularly given the gold price at this stage, but we have seen a steady improvement in mining production this year.
Yes, I think one has to be aware of reading too much into the monthly releases, as it is a very volatile release, the mining production data. But we have certainly seen a steady improvement, and the outlook for the industry going forward on the whole is positive.
Well, it's quite interesting. We spoke to Adcorp yesterday, and looking at those numbers, drilling into those numbers, one of the big sections of the economy that did relatively well in terms of employment was the mining industry. So perhaps we are going to see a little bit more of a growth potential playing out.
Yeah, I still think it's going to be non-gold. So it will be your other minerals that will do quite well. And I mean, there is great potential. The theoretical argument for that segment of the mining sector to do well is very strong. I mean, if you believe China's going to play a prominent role over the next 5 to 15 years in the world economy, given their level of development, given the fact that they are intensive commodity users, there should be demand for bulk commodities and for any form of energy, all the way through to your base metals, to your iron ores. And I think if you look at the release too, you will see it is those that export these kind of products that go in your manganeses, your chromiums, that go into sort of stainless steel, iron ore. These are the ones that have shown the best performance after we hit the severe dip late 2008, early 2009. They are the ones that came surging back, and it's mainly on Chinese demand. So from that perspective, yes, I think there's a strong case to be made.
I see you nodding, Laura. Do you expect that demand to continue coming through strongly from China? We've had some data out over the past couple of days. We've also had the central bank raising reserve requirements. We've had inflation coming in a bit higher than expected. Do you see them trying to put a dampener on some of the growth in that economy, or further dampening that, and that perhaps having an impact on commodity prices?
I think it'll be tricky for them to severely hinder the growth and dampen the prospects. But as you say, on the whole, the growth is improving. If you look at a lot of the global PMI indices, for example, you are seeing a pickup. So it's not only China that we've got to look at. If you look at the global picture, the slowdown in global growth that so many are expecting is not coming through that clearly.
What about the impact on of the rand on a mining sector, Nikki? Because that's also a bit of an issue right now when it comes to us exporting these minerals.
Oh yes, I mean, if you speak to any mining company, you will tell them that they will tell you that it's absolute slaughter. I mean, I've heard stories that if the rand goes to 630, you can pretty much just close the good door and go home and rest. That's the sort of stories that I've heard. But I think it has got a dramatic impact because your price is fixed in international terms. Obviously, it's now on an upward trend, so that's taking some of the edge off the pain they would otherwise experience as a result of the rand, and your cost is constantly rising. So clearly it is a squeeze, and it does affect your ability to compete. And in a world where, even though China is growing very rapidly, overall demand is more subdued. Global growth on average is far more moderate than it was during the roaring time from, say, 2004 to 2007. So consequently, competitiveness matters, and that is why currencies are causing such great debate and such intense tension that we're seeing now coming through at the G20.
Well, perhaps let's look at the impact of that rand on the manufacturing sector. We're getting those numbers coming out in a short while. I think the latest PMI, and that was for October, showed we were still below that 50 break-even level, jobs still being lost in the manufacturing sector. Do you think we're going to see this coming through in today's manufacturing numbers?
Yes, we do. The consensus is for a 3% print in September from 5.3%. In August, we are expecting a slightly more severe moderation, something more like 2%, and that is driven primarily by the import competition as a result of the strong rand, as well as the strike action that we had earlier this year.
That was in the auto component sector in September, wasn't it?
Yes, well, not only in the auto component sector, but that will definitely come through. So, and then in addition, you've potentially got a slowdown in demand. So, as you mentioned, we have the slight improvement in the October PMI, although still below that crucial 50 mark. All the subcomponents improved apart from the employment index, but then warranting caution on being too optimistic on the recovery in manufacturing was the slight moderation we saw in the third quarter manufacturing capacity utilization figures. Although we have to acknowledge that that deterioration was partly in the auto sector, so again you've got the strike action coming through, as well as the import competing sectors, once again the strong rand effect.
Nikki, you mentioned the G20, and I mean, looking at manufacturing globally, it's all about competitiveness, and we know that they're complaining about the big surplus that Germany has and China has. Your view on what's going to play out this weekend?
Well, I think it is really a case of, you know, one group versus the other group, you know, the manipulators versus the non-manipulators, and the rest of us that are stuck in the middle.
There are non-manipulators in this?
Well, I don't know. There are. South Africa, for example, you know, we just don't have the machinery to do so. And then you've got the stimulators versus the real austerity, serious, disciplined folks, led by the Germans, of course, in that regard. And then the British have gone that route as well, trying to punish themselves. They clearly believe it will make them better in the long term. And then the Americans, they don't believe in that sort of thing, and have now announced the QE2. And that's the big controversy, is because it indirectly does devalue the dollar, and consequently you have this renewed competitiveness problem. And the biggest concern, though, is not just the currency war, is that ultimately leads to countries instituting protectionist measures, and that it now flows through into tariff actions or even non-tariff barriers to trade, which of course would be very negative combination in this kind of global economy, where trade really have been the lifeline for many economies, because we've had the collapse in demand and in our traditional source of demand, and trade is the thing that revived the world economy at the end of the day. So if you had a protectionist war come into place now, that would be quite damaging.
And of course, Laura, we did have President Barack Obama this morning defending quantitative easing, saying they need to get the US economy back on its feet. And that's good for the global economy if the US consumer is back on its feet, isn't it?
Well, his argument was that they need to stimulate the US growth, which we can understand, but of course it is detrimental to many other countries to have, you know, this continued situation with the dollar. So our view is that we aren't necessarily going to receive any concrete decisions or concrete actions leaving out of the G20, but of course some very interesting debate is being stimulated.